EPK Capital presents Daily Brief, 19th, August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Sneha. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. The opening bell. A global market snapshot. On August 18, 2025, global financial markets navigated a complex landscape defined by significant geopolitical maneuvering, cautious central bank commentary, and a divergent set of economic data from across the world. Investor attention was sharply divided between a high-stakes political summit in Washington, D.C., which sent shockwaves through specific sectors, and the underlying economic currents shaping monetary policy expectations. The day's trading activity revealed a clear tug-of-war between the immediate risks posed by international politics and the unique domestic narratives driving individual markets, resulting in a cautious and highly selective investment environment. While U.S. technology stocks faltered under the weight of trade threats, Indian equities surged on a wave of local optimism, painting a vivid picture of a fragmented global market. This session was characterized by this stark divergence. The performance across major indices highlights a market where broad, sweeping trends gave way to more nuanced, region and sector-specific movements. The following table provides a comprehensive overview of the day's closing figures for key global indices, setting the stage for a deeper analysis of the forces at play. The data clearly illustrates the day's central conflict. The tech-heavy Nasdaq Composite underperformed significantly, while the blue-chip Dow Jones Industrial Average remained nearly unchanged, signaling a distinct rotation away from technology and growth-oriented stocks. In sharp contrast, Asian markets, led by a powerful rally in India, demonstrated remarkable strength, fueled by positive domestic developments. This divergence begs the question: what specific catalysts were responsible for these dramatically different outcomes across the globe? The answers lie in a confluence of political rhetoric, key economic data releases, and shifting central bank expectations. Wall Street's waiting game, a deep dive into U.S. markets. The U.S. stock market finished a cautious session with a mixed performance as investors grappled with fresh geopolitical risks and tempered expectations for near-term interest rate cuts. The Dow Jones Industrial Average, DJI, managed a marginal gain of 34.86 points, or 0.08%, to close at 44,946.12. However, the broader market tilted negative. The S&P 500 declined by 18.74 points, or 0.29%, to end the day at 6,449.80, while the technology-focused Nasdaq Composite experienced the most significant drop, falling 87.69 points, or 0.40%, to 21,622.98. The underlying market dynamics confirmed the bearish sentiment. On the New York Stock Exchange, declining stocks outnumbered advancers by a ratio of 1.30 to 1, with a similar ratio of 1.36 to 1 on the Nasdaq. Trading volume was subdued, with 16.3 billion shares changing hands, below the 20-session average of 18.2 billion, suggesting a lack of strong buying conviction. Meanwhile, the CBOE Volatility Index, VIX, often referred to as the market's fear gauge, rose 1.8% to 15.09, reflecting a modest increase in investor anxiety. The headline index numbers masked a significant rotation occurring beneath the surface. The day's losses were heavily concentrated in sectors most sensitive to economic sentiment and international trade. The technology select sector SPDR, XLK, fell by 0.8%, while the financial select sector SPDR, XLF, declined by 1.0%, acting as the primary drags on the S&P 500. In stark contrast, capital flowed into defensive areas of the market. The healthcare select sector SPDR, XLV, emerged as a clear outperformer, surging 1.7% as investors sought refuge in an industry perceived as more insulated from the day's geopolitical turmoil. This movement illustrates a calculated shift in strategy by market participants. The divergent performance between the Dow, which was buoyed by strong gains in stocks like United Health, and the Nasdaq, which was pulled down by semiconductor weakness, was not random. It reflected a sophisticated response to the day's specific risks. Investors appeared to be selling assets most vulnerable to geopolitical trade threats, while simultaneously buying into those with strong domestic fundamentals, effectively creating a defensive posture within their equity allocations. The semiconductor industry found itself at the epicenter of the day's geopolitical turbulence. The primary catalyst was a statement from President Donald Trump, who floated the possibility of imposing tariffs as high as 300% on imported semiconductors. This threat of extreme protectionism rattled the sector, which relies heavily on global supply chains. Consequently, shares of several major chip makers declined. Advanced Micro Devices, AMD, fell 1.13%, Broadcom, AVGO, dropped 1.12%, and NVIDIA, NVDA, also slipped as investors weighed the potential for severe disruptions to production and rising costs. However, one company stood in sharp contrast to the sector-wide sell-off. Intel Corporation, INTC, shares gained nearly 3%. This resilience was attributed to reports suggesting that Intel is well-positioned to benefit from increased U.S. government support through CHIPS Act funding. This federal backing is seen as a move to bolster domestic manufacturing, which would insulate Intel from the proposed import tariffs and could even give it a competitive advantage in a more protectionist environment. This split performance within the semiconductor industry itself underscores the nuanced way the market is processing geopolitical risk, rewarding companies aligned with national industrial policy while punishing those most exposed to global trade friction. Another notable gainer was United Health Group, UNH, which surged 3.88% after a disclosure revealed that Berkshire Hathaway had taken a stake in the company, providing a significant boost to the Dow Jones Industrial Average. The economic engine room macro forces at play. Beyond the geopolitical headlines, crucial economic data and commentary from the Federal Reserve played a significant role in shaping market sentiment. Investors are keenly focused on the path of inflation and its implications for future monetary policy, making every new data point and central banker speech a critical piece of the puzzle. Adding to the cautious mood on Wall Street were remarks from Chicago Federal Reserve President Austin Goolsbee. While leaving the door open for a potential interest rate cut in September or later in the fall, he urged caution. Goolsbee highlighted recent surges in services and producer price inflation, calling them a potential note of unease that warrants more reassuring data before the Fed commits to easing policy. These comments had an immediate impact on market expectations. The cautious tone helped lift Treasury yields, tempering the market's more aggressive bets on a September rate cut. The yield on the 10-year U.S. Treasury note rose to 4.34% during the session. Goolsbee's remarks underscore the data-dependent approach of the central bank and place even greater emphasis on the upcoming annual economic symposium in Jackson Hole, Wyoming. Investors will be scrutinizing the speech by Fed Chair Jerome Powell later in the week for any definitive signals about the future direction of interest rates. The most significant U.S. economic data release of the day came from the housing sector, providing a clear signal of the stress high interest rates are placing on the economy. The National Association of Home Builders, NAHB, Wells Fargo, Housing Market Index for August fell by 1 point to a reading of 32. This figure was below the consensus forecast of 34 and marked the 16th consecutive month the index has remained in negative territory, defined as any reading below 50. The report detailed the key factors weighing on builder confidence, with elevated mortgage rates and weak prospective buyer traffic being the primary culprits. According to the NAHB, housing affordability remains the top challenge for the market. In response to these difficult conditions, builders are increasingly resorting to measures to attract buyers. The survey revealed that 66% of builders used sales incentives in August, a figure that represents the highest level in the post-pandemic era. Furthermore, 37% of builders reported cutting prices to stimulate demand. This report is more than a simple reflection of the housing market's health. It represents a direct and public signal to the Federal Reserve from a critical, interest rate-sensitive sector of the economy. The weakness in the data was accompanied by an explicit call to action. NAHB chief economist Robert Dietz stated that given the slowing housing market, the Fed's Monetary Policy Committee should return to lowering the federal funds rate. This public plea, juxtaposed with President Goolsby's inflation-driven caution on the very same day, crystallizes the central dilemma facing the Fed. The market is now witnessing a clear tension between the Fed's mandate to control inflation and the tangible economic pain being felt in key industries. This conflict heightens the uncertainty for investors and elevates the importance of Chairman Powell's forthcoming speech at Jackson Hole, which will be parsed for any indication of how the central bank intends to balance these competing pressures. The Washington Summit, Geopolitics takes center stage. The dominant global event of the day was the high-stakes meeting at the White House between U.S. President Donald Trump and Ukrainian President Volodymyr Zelensky. The significance of the summit was amplified by the extraordinary attendance of a powerful European delegation, which included the leaders of France, the United Kingdom, Germany, Italy, and Finland, as well as the President of the European Commission and the Secretary General of NATO. This gathering was widely interpreted as a deliberate show of a united front by European allies, aimed at safeguarding Ukraine's interests and preventing President Trump from pressuring President Zelensky into an unfavorable peace agreement following his recent direct talks with Russian President Vladimir Putin. Before the official meetings began, a series of social media posts from President Trump set the tone and had a direct, measurable impact on financial markets. His comments touched upon both the war in Ukraine and U.S. trade policy, demonstrating how tightly these two arenas have become intertwined. On the subject of the war, President Trump asserted that President Zelensky could end the war with Russia almost immediately if he wants to. He further suggested that Ukraine should abandon its aspirations of joining NATO and accept Russia's 2014 annexation of Crimea. These statements created significant uncertainty regarding the future of U.S. support for Ukraine and the potential for a resolution that could destabilize the broader European security landscape. Crucially for the markets, President Trump also used this moment to issue a stark warning on trade policy. He explicitly floated the possibility of raising tariffs on imported semiconductors to a staggering 300%. This single comment was the primary catalyst for the sharp sell-off in the U.S. semiconductor sector, as it threatened to fundamentally disrupt the industry's global operating model. The timing and nature of these statements reveal a key aspect of the current administration's approach to international relations. The market's reaction indicates a growing recognition that economic leverage, particularly the threat of tariffs, is being employed as a primary tool in geopolitical negotiations. The targeting of semiconductors was not a random act of trade policy, but a strategically timed maneuver ahead of a major foreign policy summit. This deliberate blending of economic and geopolitical pressure creates a new and unpredictable layer of volatility for investors. The events of the day served as a clear case study. A diplomatic meeting concerning the war in Ukraine directly triggered significant portfolio adjustments in the U.S. technology sector. This reality forces investors to consider the geopolitical calendar as a direct source of potential event risk for specific industries, making markets more susceptible to sudden, politically driven shocks. A Tale of Two Continents, European and Asian Market Roundup. While U.S. markets were preoccupied with domestic politics and Fed speculation, trading sessions in Europe and Asia were driven by their own distinct sets of economic data and regional narratives, resulting in markedly different outcomes. European stock markets closed broadly lower on Monday, with investor sentiment weighed down by disappointing economic data from the Eurozone. The UK's FTSE 100 finished the day down slightly, while Germany's DAX index fell 0.32%. The key economic release for the region was the Eurozone's balance of trade figures for the month of June. The data revealed a trade surplus of just $7.0 billion, a sharp decline from the revised $16.5 billion surplus recorded in May, and significantly below the consensus analyst forecast of $13.0 billion. According to Eurostat, the shrinking surplus was a result of a 2.4% month-over-month decrease in exports, coupled with a 3.1% increase in imports on a seasonally adjusted basis. This combination points to weakening external demand for European goods, a potential early warning sign of a broader economic slowdown that contributed to the cautious tone across the continent's bourses. Asian markets presented a more complex and divergent picture, with underlying economic weakness in China contrasting with a powerful, domestically fueled rally in India. Although the Shanghai Composite Index rallied 0.85% on Monday, buoyed by persistent hopes for further government stimulus measures, the economic data backdrop remains challenging. Recently released figures for July painted a picture of a slowing economy. Industrial output expanded by 5.7% year-over-year, a deceleration from the 6.8% growth seen in June and the slowest pace recorded in 8 months. Retail sales, a key gauge of consumer health, also disappointed, rising just 3.7%, the weakest increase in 7 months and well below analyst expectations. This data confirms that the world's second-largest economy is facing significant headwinds, posing a potential drag on global growth. The rally in Chinese stocks suggests that investors are betting heavily that Beijing will be forced to implement more aggressive policy support to counteract this slowdown. In a stark contrast, Indian markets were the standout global performers of the day. The BSE Sensex surged 676.09 points, or 0.84%, to close at 81,273.75, while the NSE Nifty 50 jumped 245.65 points, or 1.0%, to end at 24,876.95. This powerful rally was driven by a confluence of positive domestic factors. 1. GST reform. Optimism. Investor sentiment was significantly boosted by the Prime Minister's announcement of upcoming goods and services tax, GST reforms, with widespread expectation that many goods and services will be moved into lower tax brackets, potentially stimulating consumption. 2. Sovereign rating upgrade. The market continued to draw strength from a recent decision by S&P Global Ratings to upgrade India's long-term sovereign credit rating to BBB from BBB, the country's first such upgrade in 18 years, which cited robust economic growth and improved fiscal discipline. 3. Strengthening labor market. The release of the July unemployment rate provided further positive news, showing a decline to 5.2% from 5.6% in June, indicating a healthy and improving job market. 4. Geopolitical tailwinds. A general easing of concerns over global oil supplies following the meeting between President Trump and President Putin also contributed to the positive mood. The rally was broad-based, with the auto sector leading the charge, climbing 4.2% on specific hopes of a GST cut for small cars. Shares of Maruti Suzuki, India's largest car maker, soared nearly 9% on the news. The Crypto Corner, profit-taking hits, digital assets. Following a period of exuberant gains that saw major cryptocurrencies reach new all-time highs, the digital asset market experienced a broad-based pullback on Monday. The downturn was largely attributed to profit-taking and the unwinding of leveraged positions. The market's two largest assets led the decline. Bitcoin, BTC, fell between 1.8% and 2.8% over the 24-hour period, trading in a range between $115,000 and $116,000. This represented a significant retreat from its record high of over $124,000 set just last week. Ethereum, ETH, the second largest cryptocurrency, saw a drop of approximately 3%, with its price falling to around $4,335. The negative sentiment extended to the broader altcoin market, with other major tokens such as XRP and BNB also recording losses. The primary drivers behind the day's downturn were technical in nature. After a powerful rally, a wave of profit-taking from short-term traders was the main catalyst. This selling pressure was magnified by a significant liquidation event, where over $91 million in leveraged long positions were forcibly closed in a 24-hour period, creating a cascade of automated selling that pushed prices lower. Adding to this dynamic was a noticeable rotation of capital, with some traders moving funds from Bitcoin into more speculative altcoins, temporarily reducing demand for the market leader. While the short-term price action was decidedly negative, a look beneath the surface at institutional activity revealed a completely different story. The price dip, driven largely by the liquidation of retail-oriented leveraged trades, appeared to be viewed as a buying opportunity by larger, long-term focused entities. This divergence between the behavior of short-term traders and institutional accumulators was a key theme of the day. The negative price movement, often associated with weak hands being shaken out of the market, was met with significant institutional buying. On the same day, several major announcements underscored this trend. Strategy, the largest corporate holder of Bitcoin, announced it had purchased an additional 430 BTC for approximately $51.4 million, increasing its total holdings to 629,376 Bitcoin. Bitmine, another publicly traded company, reported that its corporate Ethereum treasury had grown to over 1.5 million ETH, valued at more than $6.6 billion. A report from CoinShares highlighted record-breaking weekly inflows of $3.75 billion into crypto-related investment products, with Ethereum-based funds leading the way. This pattern, where leveraged short-term positions are unwound and the resulting liquidity is absorbed by unleveraged, long-term institutional players, is a classic sign of market maturation. It suggests that while the headline price drop may appear bearish, the underlying flow of institutional capital points to a continued and growing conviction in the digital asset class. Closing bell. Key takeaways and the path forward taking hits digital assets. The trading session of August 18, 2025, served as a potent reminder of the complex interplay of forces shaping today's financial markets. A summary of the day's critical drivers reveals three overarching themes. First, geopolitical jitters took center stage, with the Washington summit and President Trump's associated tariff threats creating significant, targeted volatility, particularly punishing the globally exposed semiconductor sector. Second, a clear pattern of economic divergence was on display, with a slowing China and a resilient, domestically driven India charting opposite courses, while the U.S. economy sent mixed signals through a weak housing market and a still cautious Federal Reserve. Finally, the cryptocurrency market underwent a period of consolidation as a healthy pullback driven by profit-taking was met with robust institutional buying, suggesting underlying strength despite the short-term price correction. Looking ahead, several key events will be critical for investors to monitor. The annual Jackson Hole Economic Policy Symposium looms large, with all eyes on Fed Chair Jerome Powell's speech for definitive guidance on the future path of monetary policy. Additionally, the upcoming release of Flash Purchasing Managers Index (PMI) data will offer the first concrete look at how the latest round of tariffs is impacting business activity in the U.S. and Europe. Finally, the market will continue to digest the official outcomes and statements from the Washington summit, seeking clarity on the future of transatlantic security and global trade relations. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.